Graham believed that the greatest obstacle to compounding was not market conditions, but investor behavior. Markets fluctuate, compounding can endure fluctuation. What it cannot endure is interference. Interference takes many forms: panic selling, overtrading, chasing performance, abandoning discipline. Each action feels justified in the moment. Each action weakens long-term outcomes. Time also exposes the difference between sustainable growth and temporary success. Strategies that rely on favorable conditions collapse when conditions change. Strategies grounded in compounding endure because they are not dependent on prediction. Graham favored durability over excitement. Compounding also aligns investing with life itself. Careers develop gradually, skills compound, relationships deepen over time. Most meaningful outcomes in life require patience. Investing is no different. Short-term thinking treats investing as a series of events. Long-term thinking treats it as a process. Compounding is the engine of that process. Another important aspect of compounding is that it rewards staying power. Investors who survive downturns benefit disproportionately from recoveries. Those who exit early forfeit future growth. Graham observed that many investors miss the most important periods of compounding because they are absent during recoveries. They sell during declines and re-enter too late. The result is a broken compounding cycle. Time does not compensate for absence. Compounding also teaches investors to lower expectations, not in ambition, but in speed. Unrealistic expectations lead to impatience. Impatience leads to disruption. Realistic expectations support endurance. Graham encouraged investors to aim for satisfactory returns achieved consistently over long periods. He believed that this approach, combined with compounding, produced superior outcomes with low risk. The quiet nature of compounding often leads investors to underestimate its power. They search for strategies that promise faster results. They overlook the cumulative effect of time. This search is unnecessary. Time, when respected, is sufficient. As compounding progresses, investors often experience a shift in mindset. They become less reactive. They focus less on daily movements and more on structural progress. They develop confidence not in prediction, but in process. This confidence is calm, not excited. Graham valued this calm. He believed it was evidence that the investor had aligned with long-term reality. Compounding does not eliminate volatility, it transforms its impact. Temporary declines matter less when long-term growth dominates outcomes. This transformation requires patience. Without patience, compounding remains theoretical. With patience, it becomes powerful. As we move forward, the contrast between those who respect time and those who ignore it becomes even clearer when we examine real stories of failure. In the next part, we will explore how investors who rushed, reacted, and abandoned discipline turned manageable situations into permanent regret. Stories of failure. When time was ignored, every market cycle leaves behind two types of stories. The first are stories of survival, quiet, rarely told, often unnoticed. The second are stories of failure, vivid, emotional, and painfully common. Benjamin Graham paid close attention to the second type, not out of fascination, but because they revealed the true cost of ignoring time. Failure in investing rarely comes from a single catastrophic decision. More often, it emerges from a series of small, impatient choices made under emotional pressure. Graham understood that impatience does not announce itself as recklessness. It presents itself as reason. Let us begin with a familiar story. There was an investor who entered the market with careful intention. He studied companies, he read reports, he avoided speculation. He believed he was investing for the long term. At first, everything seemed aligned with Graham's principles. Then, the market declined. Not dramatically at first, just enough to create discomfort. Prices dipped, headlines turned cautious, analysts began to lower expectations. The investor told himself he was prepared for volatility. He reminded himself that long-term investing required patience, but time passed, weeks became months. The recovery he expected did not arrive. Instead, prices drifted sideways. Nothing collapsed, but nothing improved. The investor began checking prices more frequently. He searched for reassurance. He read more commentary. Each new opinion added uncertainty slowly. His time horizon shrank. What had once been a long-term plan became a short-term concern. He stopped asking whether the business remained sound and began asking why the price had not moved. He interpreted delay as failure, eventually. He sold. Not in panic, calmly, rationally, he told himself. He believed he was reallocating capital more efficiently. He moved on. Months later, the asset recovered, not suddenly, but steadily, over time. It exceeded its previous value. The investor watched from the sidelines, convinced he had simply been unlucky with timing. In reality, he had failed the waiting test. Benjamin Graham saw this pattern repeatedly. Investors entered positions with discipline, but exited them with impatience. They mistook delay for error. They underestimated how long markets could remain indifferent to value. This failure was not analytical, it was psychological. Another story is even more common. An investor builds a portfolio during favorable conditions. Markets rise, confidence grows. The investor begins to believe they understand market behavior. They attribute success to skill. They increase risk exposure gradually. Then, conditions change. A downturn begins. Losses accumulate. The investor tells themselves they will hold. They recall long-term principles. But as losses deepen, emotion overwhelms reasoning. Fear replaces confidence. The investor sells near the bottom. This decision is often justified as risk management. The investor believes they are protecting capital, but Graham understood that selling during emotional extremes rarely protects anything. It converts volatility into permanence. When markets recover, as they often do, the investor hesitates to re-enter. They wait for confirmation. Confirmation arrives late. Gains are missed. This story is repeated across generations. Graham observed that most investors do not lose money because they buy poor assets, but because they abandon good ones at the wrong time. Time was available. It was ignored. There is another type of failure that Graham found particularly tragic. The investor who abandons patience for excitement after enduring a long period of stagnation. Some investors grow restless. They seek stimulation. They chase trends. They move into popular assets promising faster gains. Often, these decisions occur just as long-term positions are about to recover. The investor sells a quiet, undervalued asset to buy something exciting. The excitement fades. The new position declines. The original asset rises. This sequence is devastating psychologically. Regret compounds loss. Confidence erodes further. Graham believed that boredom was a more dangerous enemy than fear. Fear is visible. Boredom works quietly. Another story Graham saw often involved overreaction to news. A company faces temporary difficulty, earnings decline. A regulatory issue emerges, investors react immediately. Prices fall sharply. Those focused on the short-term sell, long-term investors reassess. They ask whether the difficulty threatens the business's long-term viability or merely its short-term performance. Impatient investors do not wait for this distinction to become clear. They sell quickly, often at distressed prices. Later, when conditions normalize, they realize the problem was temporary. Time would have clarified the situation. It was not given the chance. Graham believed that time is the greatest filter of relevance. Important problems persist, unimportant ones fade. Short-term thinking treats all problems as urgent. Long-term thinking distinguishes between noise and substance. Failure often results from ignoring this distinction. Another recurring story involves investors who confuse effort with effectiveness. They research constantly. They trade frequently. They adjust portfolios endlessly. They believe this activity protects them. In reality, it exhausts them. When fatigue sets in, decision quality declines, errors increase, confidence collapses. Graham believed that overactivity was a sign of insecurity, not skill. He observed that investors who traded the most often performed. The worst. Time punishes overactivity. There are also stories of investors who believed they could exit temporarily and return later. They sold during downturns, confident they would buy back at lower prices. Sometimes they succeeded briefly. Eventually, they failed. Markets moved unpredictably. Re-entry points were missed. Discipline eroded. Graham believed this approach underestimated the difficulty of timing markets consistently. One correct decision was not enough. The investor needed repeated correctness. Time exposes the fragility of such strategies. Another painful story involves the investor who waited, but not long enough. They held through moderate losses, but sold when discomfort peaked. They believed they had endured sufficiently. In reality, they exited just before recovery. This timing is tragically common. Graham understood that markets often inflict maximum emotional pain just before conditions improve. Impatience reaches its peak near turning points. Waiting slightly longer would have changed outcomes dramatically. Time was almost respected. Almost is not enough. Graham also observed failure driven by comparison. Investors measure success relative to others. When others appear to succeed faster, patience erodes. The long-term investor feels foolish. They abandon strategy to keep up. Comparison shortens time horizons. Graham believed that comparing short-term outcomes undermines long-term success. Each investor's journey unfolds differently. Time rewards consistency, not conformity. Many investors fail because they adopt long-term language but short-term expectations. They say they are patient but expect quick results. When those results do not arrive, disappointment becomes action. Graham believed that long-term investing must be internalized, not declared. Failure stories share a common theme. Time was available. Time would have helped. Time was ignored. These investors were not reckless. They were human. Graham did not judge them harshly. He studied them carefully. He understood that their mistakes were predictable, repeatable, and avoidable. This is why he emphasized patience relentlessly. He believed that investors must be trained to endure discomfort. Not because discomfort is desirable, but because it is inevitable. In the next part, we will explore the other side of this contrast, stories of success that rarely make headlines. These are stories of investors who waited quietly, endured uncertainty, and allowed time to do its work. Stories of success when time was respected. For every story of failure caused by impatience, there exists a quieter, less visible story of success built on endurance. These stories rarely dominate headlines. They do not circulate widely. They are not exciting in the moment. Yet they are the stories Benjamin Graham believed mattered most, because they reveal what happens when time is respected rather than resisted. The long-term investor who succeeds often looks unremarkable while success is being built. Consider an investor who purchases a collection of sound businesses at reasonable prices. The companies are not fashionable. They do not promise dramatic growth. Their earnings grow slowly, steadily, year after year. There are no sudden surges in price, no thrilling moments of validation. Years pass, markets fluctuate, crises come and go, headlines change, entire investment styles rise and fall in popularity. Through it all, the investor holds. From the outside, nothing appears to be happening. This is the nature of long-term success. Benjamin Graham understood that meaningful outcomes develop invisibly, while others react to noise. The patient investor allows substance to accumulate quietly. Over time, earnings compound, balance sheets strengthen, competitive positions solidify. Eventually, the market notices prices rise not because of excitement, but because reality has become undeniable. What once appeared stagnant now appears stable. What once seemed boring now appears reliable. The investor benefits not from timing, but from endurance. Graham believed that this kind of success is invisible. While it is happening, only in retrospect does it appear obvious. Another story Graham observed involved investors who endured prolonged downturns without abandoning discipline during periods of widespread fear. Markets often punish even strong businesses. Prices fall. Across the board, sentiment becomes uniformly negative. Short-term thinkers retreat. Long-term investors reassess. They examine fundamentals. They review balance sheets. They confirm that businesses remain viable. Then they wait. This waiting is not passive. It is deliberate. It is informed by analysis and reinforced by structure. As time passes, conditions normalize. Fear fades. Earnings recover. Prices rise. Those who endured benefit disproportionately because they remained invested during the most difficult periods. Graham believed that markets reward those who stay present when others leave. Presence is not activity. It is endurance. There are also stories of investors who resisted the temptation to chase trends. As new industries emerge, excitement grows, narratives dominate conversation, prices rise rapidly. Many investors abandon long-term strategies to participate. Some succeed briefly. Many fail. Long-term investors observe calmly. They acknowledge innovation but refuse to overpay. They recognize that enthusiasm often precedes reality. They wait for valuation to align with substance. Often, they appear foolish in the short term. They miss early gains. They are criticized for being conservative. Time clarifies outcomes. When enthusiasm fades and prices adjust, long-term investors act selectively. They acquire quality assets at reasonable prices. Their patience allows them to participate later. With low risk, Graham believed that missing early excitement is not a failure, it is often a form of P. Roddy's CTIO in Another quiet success story involves investors who held through periods of stagnation. Markets do not always trend upward. There are long periods where prices move sideways. These periods test patience more than volatility does. Nothing dramatic happens. There is no crisis to justify discomfort. There is only waiting. Many investors abandon positions during these phases, seeking activity elsewhere. Long-term investors remain. They understand that stagnation does not equal deterioration. Businesses continue to operate, earnings continue to accumulate, dividends continue to be paid, value builds beneath the surface. Eventually, conditions change. Stagnation gives way to growth. Those who waited benefit from years of accumulation. Graham believed that the rewards of patience are often delayed until patience is nearly exhausted. There are also stories of investors who succeeded simply by not interfering. They built diversified portfolios. They selected quality assets. They rebalanced occasionally. They avoided emotional decisions. They allowed time to work. These investors did not seek excitement. They sought reliability over decades. Their portfolios grew steadily. Losses were absorbed, gains compounded, volatility was endured. Their success was not dramatic. It was durable. Graham valued durability above all else. Another important category of success involves investors who learned to redefine success itself. Rather than measuring success by short-term returns, they measured it by consistency, survivability, and peace of mind. They accepted that markets would fluctuate and that outcomes would vary year to year. This mindset reduced stress. Reduced stress improved decision-making. Improved decisions reinforced discipline. Time rewarded this cycle. Graham believed that emotional stability is a competitive advantage. Investors who remain calm under pressure make fewer mistakes. Fewer mistakes lead to better long-term outcomes. Stories of success often include moments of doubt. Long-term investors are not immune to fear or uncertainty. They experience discomfort like everyone else. The difference is that they do not act on it impulsively. They allow doubt to exist without allowing it to dictate behavior. This restraint is what distinguishes them. Graham also observed that successful long-term investors often appeared inactive. They did not trade frequently. They did not comment constantly. They did not seek attention. Their activity was concentrated at moments of opportunity, not distributed across noise. Time magnified the impact of this selectivity. Another common success story involves investors who maintain discipline during periods of widespread pessimism. When markets fall sharply, pessimism dominates. Predictions become dire. The future appears uncertain. Many investors exit entirely. Long-term investors maintain perspective. They recognize that pessimism exaggerates risk, just as optimism exaggerates opportunity. They do not assume recovery will be immediate. They do not assume collapse is permanent. They remain invested. When recovery occurs, as it often does, their endurance is rewarded. Graham believed that the ability to endure pessimism without capitulation is one of the most valuable investing skills. There are also stories of investors who benefited from reinvestment over time. Dividends reinvested during downturns accumulate additional shares at lower prices over time. This accumulation enhances returns significantly. This process requires patience. Short-term investors often interrupt reinvestment by selling during downturns. Long-term investors allow reinvestment to continue. Time amplifies the difference. Graham understood that these advantages compound quietly. They are not visible in single years. They emerge over decades. Another quiet success involves investors who ignored predictions. Markets are full of forecasts, economic projections, interest rate expectations, and geopolitical scenarios dominate commentary. Many investors base decisions on these predictions. Long-term investors listen selectively. They acknowledge uncertainty. They do not anchor decisions to forecasts. Instead, they build portfolios that can endure multiple scenarios. time allows this resilience to matter. Graham believed that robust strategies outperform precise predictions. Stories of success often share one final trait: humility. Successful long-term investors do not claim mastery over markets. They do not believe they can control outcomes. They respect uncertainty. They respect time. This humility protects them from overconfidence during good times and despair during bad times. Time rewards humility because humility encourages patience. As these stories illustrate, success through long-term thinking is rarely dramatic. It is gradual, quiet, and often unnoticed. It requires enduring discomfort without reaction. It requires trusting process over excitement. Benjamin Graham believed that this form of success was the only kind worth pursuing. In the next part, we will examine volatility, drawdowns, and survival. Why Graham believed that avoiding permanent loss was more important than achieving extraordinary gains, and how time transforms volatility from a threat into a test. Volatility, drawdowns, and the meaning of survival. Benjamin Graham did not define risk the way most people do. To him, risk was not volatility. It was not daily price movement. It was not temporary loss. Risk, in its truest form, was the permanent loss of capital. Everything else was noise. This distinction is essential to understanding why Graham believed so strongly in a long-term perspective. Volatility is unavoidable. Markets fluctuate. Prices rise and fall. This movement is not a flaw of market set. Is their nature. Graham accepted volatility as a constant and designed his philosophy around enduring it rather than eliminating it. Short-term thinkers view volatility as danger. Every decline feels threatening. Every drawdown feels like failure. The instinctive response is to escape discomfort as quickly as possible. Long-term thinkers view volatility differently. They see it as a test rather than a threat, a test of discipline, a test of preparation, a test of patience. Graham believed that volatility only becomes dangerous when investors react to it emotionally. Drawdowns are inevitable in investing. Even the strongest businesses experience periods of decline. Even the most disciplined portfolios suffer temporary losses. Graham never promised investors a smooth journey. He promised them a survivable one. Survival was his priority. A drawdown does not destroy wealth by itself. What destroys wealth is capitulation, selling during a drawdown because discomfort becomes unbearable. This is where time becomes decisive. Time allows drawdowns to heal. Markets recover not because investors hope they will, but because economic activity continues. Businesses adapt, earnings normalize. Capital finds opportunity. Over time, reality reasserts itself. Short-term thinking interrupts this healing process. Investors exit before recovery can occur. They convert temporary decline into permanent loss. Graham saw this repeatedly. He observed that investors often sold not at the beginning of downturns, but near their emotional peak. Fear intensified gradually. Losses accumulated. Confidence eroded. Eventually, the pain became too great. Selling provided relief, but at enormous cost. Long-term investors experience the same fear, but they do not allow it to dictate behavior. They expect drawdowns. They prepare for them mentally and structurally. Preparation changes experience. Graham believed that investors should assume drawdowns will occur and design portfolios accordingly. Diversification reduces severity. Margin of safety reduces regret. Long-term perspective reduces urgency. Together, these elements create survivability. Survivability is more important than optimization. An optimized portfolio that cannot survive stress is inferior to a conservative portfolio that endures. Graham rejected strategies that produced impressive results under favorable conditions but collapsed under pressure. He believed that the true measure of an investment strategy was how it performed during adversity. Volatility exposes weakness. Short-term investors often rely on favorable conditions. When those conditions change, their strategies unravel. Long-term investors rely on structure. Structure holds under stress. Graham also recognized that volatility has a psychological dimension. Price declines trigger fear not only because of financial loss, but because they threaten identity. Investors feel judged by the market. They feel exposed. This emotional dimension is often underestimated. Graham believed that investors must separate self-worth from portfolio value. Long-term thinking helps create this separation. It frames volatility as temporary rather than personal. This framing is critical for survival. Drawdowns also reveal the importance of liquidity. Investors who lack liquidity are often forced to sell during downturns. They do not choose to exit, they must. Graham believed that long-term investing required flexibility. Investors should not depend on immediate market performance to meet obligations. Liquidity allows time to work. Time without flexibility is fragile. Another reason drawdowns are so dangerous is that they invite reinterpretation. Investors begin to doubt original assumptions, they magnify risks, they minimize strengths. This reinterpretation is often driven by emotion rather than new information. Graham warned against this behavior. He believed that reassessment should occur when facts change, not when feelings do. Volatility changes feelings far more often than it changes facts. Long-term investors distinguish between price movement and fundamental change. This distinction allows them to endure volatility without paralysis or panic. Graham also observed that volatility creates opportunity. Mispricing increases during emotional extremes. Assets become undervalued not because their prospects have deteriorated, but because fear dominates judgment. Long-term investors who survive downturns are often positioned to benefit from these opportunities. Short-term investors, having exited, are not. Time rewards those who remain present. Survival also depends on expectation management. Investors who expect volatility are less shocked by it. Shock amplifies fear, anticipation reduces it. Graham encouraged investors to normalize drawdowns mentally. They are not anomalies. They are features. By expecting volatility, investors reduce its emotional impact. Graham also emphasized that survival requires humility. No strategy avoids all losses. No investor avoids all mistakes. The goal is not perfection, it is endurance. Long-term thinking accepts imperfection. It allows mistakes to be absorbed rather than amplified. Short-term thinking magnifies mistakes. Each error feels catastrophic. Urgency replaces reflection. Time smooths error. Another critical insight Graham developed was that avoiding ruin is more important than achieving brilliance. Many investors chase extraordinary returns. They accept high risk. They expose themselves to strategies that work until they do not. When failure occurs, recovery is impossible. Long-term investors prioritize staying in the game. Staying in the game allows learning, adjustment, and compounding. Exiting permanently ends all possibility. Time favors those who remain. Drawdowns also reveal the danger of leverage. Leverage accelerates outcomes in both directions. During drawdowns, it forces liquidation. Time becomes irrelevant because survival is compromised. Graham warned strongly against leverage for this reason. He believed that long-term investing required staying power, not amplification. Staying power depends on structure. Volatility tests that structure relentlessly. Investors who endure volatility develop confidence not in markets, but in themselves. They learn that fear passes. They learn that patience matters. They learn that time heals. This confidence is not arrogance, it is experience. Graham believed that investors who survive multiple cycles develop a deeper understanding of markets. They stop reacting. They start observing. Observation replaces fear. As we approach the final part of this discussion, one theme becomes unmistakable. Long-term investing is not about avoiding difficulty. It is about enduring it intelligently. Time does not eliminate volatility. It makes it survivable. In the final part, we will bring all these ideas together and examine the mindset of the long-term investor, how they think, how they behave, and why time ultimately becomes their greatest edge. The long-term investor's mindset. Time as the only real edge. By the time Benjamin Graham reached the later stages of his career, he no longer believed that investing success depended primarily on intelligence, access to information, or even superior analysis. After decades of observing markets and investors, he came to a quieter, more powerful conclusion. The greatest edge an investor can possess is the ability to think long-term when others cannot. This edge is not visible. It does not appear on charts. It cannot be measured quarterly, yet it determines outcomes more reliably than any strategy. The long-term investor does not experience markets the way most people do. They see the same prices, the same headlines, the same volatility, but they interpret them differently. Where others see urgency, they see cycles. Where others see chaos, they see repetition. Where others see threat, they see testing. This difference in interpretation defines everything. The long-term investor understands that markets are not designed to reward comfort. They are designed to challenge conviction. They create uncertainty, not to inform, but to provoke reaction. Most participants react, a few remain steady. Graham believed that steadiness was not passive. It was a deliberate stance taken against emotional pressure. The long-term mindset begins with acceptance that markets will fluctuate, that prices will mislead, and that outcomes will not arrive on a convenient schedule. This acceptance removes the need to react. When nothing is surprising, nothing feels urgent. Urgency is the enemy of judgment. Short-term investors live in a state of urgency. They feel compelled to respond to every movement. They believe that missing action is missing opportunity. This belief traps them in constant decision-making. The long-term investor rejects this belief. They understand that most opportunities do not disappear quickly. True value persists. If an opportunity requires immediate action to be captured, it is often speculation disguised as investing. Time filters opportunity. The long-term mindset also reframes success. Instead of asking, "How much did I make this year?" the long-term investor asks, "Did I maintain discipline?" Instead of measuring returns alone, they measure behavior. This shift is subtle but powerful. Graham believed that behavior determines returns over time far more than strategy does. A mediocre strategy followed consistently outperforms a brilliant strategy followed inconsistently. Time amplifies consistency. The long-term investor also understands that boredom is part of the process. Long periods of inactivity are not signs of failure. They are signs that nothing requires action. Markets do not offer meaningful opportunities continuously. They offer them occasionally. Patience fills the gaps. Graham believed that investors should expect long stretches where the best decision is to do nothing. Those who cannot tolerate these stretches often create problems for themselves by forcing activity. The long-term mindset embraces selectivity. Another defining trait of the long-term investor is emotional independence. They do not rely on market movement for validation. Their confidence does not rise with prices or collapse with declines. This independence is essential because markets offer inconsistent feedback. Short-term markets reward behavior randomly. Long-term markets reward behavior eventually. The long-term investor chooses the latter. This mindset also involves humility. Long-term investors do not believe they can predict markets reliably. They accept uncertainty as permanent. Instead of trying to eliminate uncertainty, they build portfolios and processes that can survive it. This humility protects them from overconfidence during good times and despair during bad times. Graham believed that humility was not weakness, it was realism. The long-term investor also understands that mistakes are inevitable. What matters is not avoiding all errors, but avoiding errors that cannot be repaired. Time can heal many mistakes. It cannot heal ruin. Avoiding ruin is the foundation of long-term success. This is why Graham emphasized margins of safety, diversification, and conservative assumptions. These tools do not guarantee success, but they increase survivability. Survivability allows time to work. Time is unforgiving to those who exit early. Time is generous to those who endure. The long-term mindset also changes how investors view volatility. Volatility is no longer something to escape, it becomes something to endure and, occasionally, to use. Price movement is information, not instruction. The long-term investor does not panic during declines because they understand that declines are part of the process. They also do not become euphoric during rallies because they know enthusiasm fades. This emotional balance is rare. Graham believed that investors who master this balance achieve something more valuable than high returns. Control over their behavior. Behavioral control is the true competitive advantage. Over time, the long-term investor develops a deep trust in process. This trust is not blind. It is built through experience, through surviving downturns, enduring stagnation, and watching value eventually assert itself. Experience reinforces patience. As this trust grows, the investor becomes less reactive. They stop seeking reassurance. They stop chasing validation. They allow decisions to mature. Time transforms effort into outcome. The long-term mindset also brings clarity. When decisions are made infrequently and deliberately, they carry more weight. Each choice is considered carefully. Each commitment is taken seriously. This seriousness reduces noise. Graham believed that investing should not dominate one's life, it should support it. Long-term investing allows this balance. It frees mental energy, it reduces anxiety, it creates space for perspective. Perspective is impossible when time horizons are short. The long-term investor also understands that markets do not reward speed, they reward endurance. They do not reward cleverness alone, they reward discipline sustained over years. This is why time is the only real edge available to most investors. Information is widespread, tools are accessible, strategies are shared. But patience remains scarce. Time favors those who can wait when others cannot. Graham believed that investing was never meant to be exciting. Excitement belongs to speculation. Investing is meant to be methodical, cautious, and patient. Those who accept this reality stop fighting the market and start aligning with it. Alignment with time is alignment with reality. In the end, long-term investing is not about predicting where markets will go next. It is about building a mindset and structure that can endure wherever markets go. This endurance is not dramatic. It does not produce constant satisfaction, but it produces results. Benjamin Graham's legacy is not a set of rules, it is a way of thinking. At the center of that thinking is a simple truth that markets confirm again and again. Those who respect time are rewarded by it. Those who rush are punished by it. Final endnote in investing. Brilliance fades quickly. Discipline endures. The market will tempt you to react. Time will ask you to wait. Most will react. A few will wait. And in the long run, waiting is the difference between noise and wisdom, between activity and progress, between speculation and investing. Time is not just part of the journey. Time is the journey. Investing is not about predicting the next move of the market. It is about building the discipline to stay rational when the market is not. Short-term noise will always exist. Prices will rise and fall, opinions will change, fear and excitement will come and go. But time rewards those who remain patient, consistent, and grounded in value. The goal is not to be right quickly, but to be right eventually. If you can think long-term while others think short-term, if you can wait while others react, and if you can stay disciplined when emotions run high, then time becomes your greatest advantage. That is the mindset of intelligent investing. That is the philosophy we explore on this channel. Thank you for listening. Stay patient, stay disciplined, and let time work for you.